Welcome to Factful Finance, where we dive deep into the world of smart money moves. Have you ever thought about what would happen to your mortgage if something unexpected happened to you, like a job loss, serious illness, or even death? Many homeowners are caught off guard, not realizing that there are insurance options designed specifically to protect their home in case of life's unforeseen challenges. Today, we're unpacking the different types of mortgage protection insurance, MPI, from death coverage to job loss protection and more. By the end of this video, you'll have a clear understanding of what's available so you can make informed decisions to safeguard your home. Let's jump right in. Before we dive into the details, a quick disclaimer. This content is for educational purposes only. We're not endorsing any particular product or service, and we always recommend you consult a professional for personalized advice. First up, standard death coverage. This is the most common form of mortgage protection insurance. It's designed to pay off your mortgage in the event of your death. Sounds straightforward, right? Let's say you're the primary breadwinner in your household. If something happens to you, the last thing your family wants is the burden of losing the home. A death policy can help your loved ones keep their home without worrying about monthly mortgage payments. It's a simple and powerful way to provide peace of mind for your family. Next, let's talk about disability or critical illness coverage. This policy covers your mortgage payments if you're unable to work due to a disability or a severe illness. Think about James, who suffered a serious back injury while working in construction. His injury kept him from earning an income for several months. Having disability coverage meant his mortgage was still covered while he recovered, so he didn't have to stress about missing payments while focusing on his health. Then there's job loss protection. Life happens, and sometimes it means losing your job. Job loss coverage can kick in to cover your mortgage payments during periods of unemployment. For example, Emma, a marketing professional, was laid off when her company downsized. Thanks to her job loss protection, she was able to avoid falling behind on her mortgage payments while she searched for a new job. This coverage can often be added to your MPI as an add-on or purchased separately. Now, there's something that might sound like a safety net: temporary coverage or short-term insurance. This is typically for a limited duration. Let's say you're laid off, and the policy will cover you for just 6 months. Or perhaps you're facing a short-term health challenge. These types of policies are there to cover you during specific situations, but won't last forever. It's a good option if you're looking for something that fills a short-term gap without committing to long-term coverage. One of the more intriguing options is return of premium MPI. Some MPI policies offer you a return of premiums if you don't make a claim during the term of the policy. This can be an attractive feature for some homeowners because it means if you stay healthy, employed, and don't need to use your MPI, you could get your premiums back. Let's say Benjamin, who purchased an MPI policy 10 years ago, never had to use it. At the end of his policy term, he's refunded the premiums he paid over the years. It's a win-win if you don't need to tap into the coverage, and a great incentive for those who are cautious but still want protection. Now, let's take a step back. With all these options, which one is right for you? Experts recommend assessing your lifestyle, financial stability, and the risks you face before choosing MPI. If you're the primary income earner and want to protect your family in the event of death, a standard death policy might be your best bet. If you're worried about losing your job or falling ill and being unable to work, then adding job loss protection or disability coverage might be essential. The good news? You don't have to navigate this alone. Speak with an insurance advisor to find the best combination of coverages for your unique situation. What about the cost? Let's be real. MPI premiums vary based on factors like your age, health, and the size of your mortgage. Typically, premiums range from 0.5% to 1.5% of your mortgage amount annually. So while it can be an added expense, it's an affordable investment when you consider the security it offers. So what do you think? Is mortgage protection something you've considered before? Let me know in the comments. What's your biggest financial goal this year, and how can MPI play a role in it? Thank you for joining us here at Factful Finance. If you found this information useful, why not hit that subscribe button and ring the bell so you don't miss out on more tips that could help you protect your financial future. If you enjoyed this video, we think you'll find the one shown on your screen next just as insightful. Trust me, you won't want to miss it. See you next time, and stay financially empowered.